ladies and gentlemen, distinguished guests, welcome to this panel discussion. Today we gather to delve into the complexities and challenges faced by the insurance companies and our clients in navigating the ever-evolving landscape of risk. In this dynamic industry, it is essential for us to identify and mitigate risks effectively to maintain stability, protect policy holders, and ensure sustainable growth. Let us explore some of these major risks that pose significant challenges to the insurance sector. So for instance, with global warming that we talked about earlier in the previous panel, so we have catastrophe events and natural disasters over the years, especially recently. So these events not only cause widespread damages, but also test the resilience and solvency of insurers. So the insurance sector is a major investor, and insurers often invest policy holders' premium to generate returns and ensure the stability to meet future obligations. However, market volatility, economic downturns, interest rate volatilities will obviously affect investment returns and risk profiles. And there are other risks that we will look at today. So without further ado, let us comments on our panel discussion on the heat map of global financial markets. But before we start with our polling question, so please, can we have the polling question? Right. So let's please put in your answer. Right. So what's your view? What's the biggest threat to the global financial stability? Interest rate risk. Right? So geopolitical tension. That's the biggest elephant in the room. Okay. So I think we have more or less, all the answers. So, okay. So let's start this panel discussion. Let me first introduce our distinguished speakers one by one. James MCCORMACK, Managing Director and Global Head of Sovereign and Supranational Ratings at Fitch Ratings. James has decades of experience as an economist and senior executive in credit risk management. James earned a BA in economics from York University, Canada, and an MA in international economics from the University of Toronto. Matthew MICHELINI, head of Asia Pacific at Apollo and a member of firm's leading team. And he has a lot of experience in private equity, especially playing a pivotal role in the creation and success of many of Apollo's largest growth initiatives. Previously, Matt was a member of the M&A group at Lazard. And Romain PASEROT, Deputy Secretary General and Head of Capital and Solvency and IAIS, where he notably oversees activities and projects related to financial stability and capital and solvency. And Romain is also a member of the IAIS Advisory Board. Last but not least, Ms. Jayne PLUNKETT, Group Risk Officer at AIA Group, where she's responsible for the group's risk and compliance functions. She also sits on the board of various companies within the group. Jayne was the CEO at Reinsurance Asia at Swiss Re before joining AIA. So she's also a fellow of the Casualty Actuarial Society and a member of the American Academy of Actuaries. Okay. So now that we have the polling result, so let's look at some of these risks. Maybe I'll first start my question with on rating, on global risk rating, because agency assesses creditworthiness and risk profile of different entities and countries. So what are the common challenges and risks that these various financial markets in different countries are facing? And also, sovereign ratings sometimes are at risk. So what can trigger these kind of further downgrades? So let's turn this question to James.
Okay, thank you very much. Thanks for the kind invitation to join you here today. I guess I better address that polling response. So there was a runaway winner in terms of geopolitical risks. So let me maybe I should start there and then talk about some of the other risks that we're focused on, at least my team is focused on from a sovereign credit perspective. It's been a busy year on that front, and I think 2024 will be the same. So in terms of geopolitical risk, I'm not surprised at all that that's the #1 risk that people have identified. We do a lot of conferences around the world, and we do similar polls, and that seems to be the #1 answer globally. So that view is shared. I think that's easy to understand as we go into 2024. There are 2 hot wars, one in Ukraine, one in Israel, and neither one of them appear to have a conclusion that is sort of imminent, a solution at hand. So those look like they're going to continue into 2024. And when you turn on the news, that's what you hear. And so it's not a surprise that people are focused on geopolitical risks. I would say that the market reaction, the financial market reactions to both of those conflicts is probably a little bit more measured than we might have anticipated, before as they began, or even before they began. But nevertheless, the economic implications are quite significant, and we've taken a number of rating actions around both of those conflicts, and I suspect we will continue to do that into 2024, primarily in Central and Eastern Europe, the countries that are most exposed to what's going on in Ukraine. It's all indirect exposure, really, in terms of the economic implications. Czech Republic, Hungary, Poland, the Baltic countries, some of those are definitely in focus. And around the conflict in Israel, we put Israel on rating watch negative, and we're pretty focused on the potential spillovers to Egypt for one, and Jordan for another. So we've kind of got a watch on a couple of countries in that part of the world. But I would say this, it's not all doom and gloom. And I think as we go into 2024, there's at least one sort of geopolitical issue that we're maybe a little bit more optimistic about than we have been in the last year or maybe the last 2 years, and that's the big one. That's China-U.S. So when we think about China-U.S. relations and the risks around that, it seems to us that there have been some positive developments in the last few months in terms of dialogue, direct dialogue between the 2 countries. And we can talk about the reasons and the motivations for that. I think both countries are motivated to put that relationship back on a sounder path, whether those reasons are political or economic, probably a bit of both in both countries. But nevertheless, we think there's an opportunity for that to continue into 2024. One caveat, I think, with 2024, and when we think about political and geopolitical risks, it's a heavy election year. So in this part of the world, India, Indonesia will be having elections. Pakistan have elections in 2024. And of course, the US is going to have elections in 2024. So all of those issues I just mentioned, the positive developments potentially between China and the US, we do have to think about that in the context of an election year. So I'll just say that about the geopolitical issues at the outset. To the core of your question in terms of the issues that we're focused on from a sovereign credit perspective, My team also does all our global macro forecasting as well. So let me just tell you a couple of things that we're focused on as we go into the new year. And this came up in the earlier panel, and it was on your list of risks, but I think there are really three things. Number one, economic growth. Number two, inflation. Number three, interest rates. So inflation and interest rates, we haven't really had to think about this for at least 10 years. So this is kind of new. So we're getting back into the swing of thinking about those things. On the growth front, clearly, we think it's quite clear that growth is coming down. So we expect U.S. growth next year to be somewhere between 1% and 1.5%. That's below potential. The U.S. should grow between 1.5 and 2. But a slowdown is, we think, inevitable just because the impact of higher interest rates has not yet worked its way through to the real economy. So I think, the U.S. economy is clearly already slowing. We think we can see that in the fourth quarter. Third quarter was a very robust number. The nowcast for the fourth quarter is much lower, and we think that weaker growth will continue into next year. In Europe, we see continued weak growth, and I'm talking about the Eurozone. So probably growth of less than 1% in the Eurozone. It's been bumping along at that level already, so not a big difference, not a big reduction in growth. And then in China, we've got 4.6 for next year, 4.6 for 2025. So we think that is a reasonable growth number for China. I think, the forecasts for China kind of move around a lot. We saw that this year, and I think we may see that again next year. The two other issues in terms of inflation and interest rates, clearly we're in a period of disinflation, not deflation, not everywhere. There's deflation in some jurisdictions, but not everywhere. Disinflation clearly has taken hold. So the question is, how low is inflation going to go, and what are central banks going to do about it? So we think that inflation by the end of 2024 will still be above central bank targets. And here I'm talking about the US and I'm talking about the Eurozone. That is not going to prevent central banks from bringing policy rates lower. So if you look at Fed funds futures, the first interest rate cut is expected in March now. That's quite early. That's not that far away. We think it'll probably be closer to the middle of next year, but by the end of 2024, policy interest rates in the US, somewhere between 75 and 100 basis points lower than where we are today. Eurozone interest rates also lower. But the inflation issue is not fully resolved. I think what we have more confidence in is this policy rate path. The bigger question really, I think, for people in this room is not policy rates, but market rates, longer-term interest rates. We've all seen the volatility in U.S. Treasury markets this year, markets that we typically are not accustomed to seeing volatility in at, say, the 10-year yield level, moving a lot within the course of this year. So I think there is an open question as to where 10-year yields are going to be in the United States a year from now and 2 years from now. Are we going back to pre-COVID levels, or are we going back to pre-global financial crisis levels? And I think that's the question we need to ask, because before COVID and after the global financial crisis, we were in a period of interest rates being suppressed in part by policymakers, central banks primarily, pushing interest rates lower for longer. And so I think that environment is clearly over, and we should be thinking about a higher equilibrium, longer-term interest rate in the United States, and clearly that is the benchmark interest rate globally. So we think that if you look back over a long enough period of history, 10-year Treasury yields in the U.S. typically are a little bit lower on average than nominal GDP growth. Or you can think about it in real terms, the real 10-year yield a little bit lower than the real GDP growth rate. So that would put 10-year yields somewhere in the order of 3.5% to 4%, or 3.5% to say 4.5% over the next 12 to 18 months. That's different than where we were pre-COVID. So we think we're moving back to a world of higher interest rates. And then when we think about that from a rating perspective, and I'll close with this, I look at government balance sheets, and government balance sheets are quite stressed. So government debt, as we all know, higher now than it has been historically in most countries. So in a world of higher interest rates, that means additional fiscal stress. And when we look at what governments are also spending money on, they're spending more on defense, they're spending more on climate investment, energy transition. So there's a long list of spending priorities, and now we have to deal with higher interest payments as well. And just to give you one concrete example of what higher interest rates mean to the interest payments of governments, in the US, as recently as the middle of 2021, on sort of a 12-month trailing basis, the government was paying something in the order of $300 billion for interest on the debt. It is now paying almost $700 billion. So that's more than double the interest payments. And the debt hasn't clearly doubled between 2021 and where we are today, but the interest payments have. So this rising interest rates, if we're working towards a new equilibrium of higher interest rates, is an issue for government finances, and that is something that policymakers are going to need to address, not just in 2024, but in the years that follow. Maybe I'll stop there.
Oh, thank you so much, James, for that detailed overview. You talked a lot about interest rate risk. Actually, I want to go to Matthew on this, because Apollo is well known for its alternative investment expertise, and it has done well in a very low interest rate environment over the past 2 decades, actually. So now, with a rising interest rate environment, what are the opportunities and also risk from your perspective, especially if, for insurance companies?
Sure. First of all, thank you for having us. We were one of the early trendsetters in what Kevin mentioned earlier today about a marriage between asset managers and insurance. Although I think his asset management earnings are a bigger percentage of his business than they are for ours at this point. But look, there's been a increased adoption of alternatives for actually a very simple reason. It's the unwinding of the misbelief that public is safe and private is risky. What we've all found out over the last 3 years, is that that statement conflated 2 risks, liquidity risk and asset risk. And so you ask yourself today, is the S&P safe? Well, we all know it's comprised of a handful of stocks, trading at an all-time high in PE, and those handful of stocks traded at 50 times PE, none of which we'd probably individually buy for our personal accounts because it sounds expensive. Then you ask yourself the question, well, is the investment-grade bond market risky or safe? You think safe. But if you're holding those bonds so that you can get liquidity at par, it's risky. Because the investment-grade bond market is all driven by flows. The marginal buyer is an open-ended mutual fund. When inflows come in, they buy. When flows go out, they sell. That was the case with UK LDI last year. So it depends on what your objective function is. Then you go to the private assets. In the private assets, we ask ourselves the question, when AT&T issues to us an A-rated private debt security, risky or safe? Well, safe from a credit risk perspective, so long as you have funded it with capital that doesn't need liquidity. So it really depends on one's objective function and what they're trying to solve for when they look at private assets. And you look over a long period of time, 10 years, 20 years, 30 years, private assets have outperformed public assets. Now, and that was even in an environment where you had massive beta tailwinds propping up the public markets. Those beta tailwinds are unlikely to sustain the public market returns over the next 10 years. Now, obviously, you can't have a portfolio of all private assets. You need some liquidity. You have to have some beta. You have to have some alpha. You have to really take advantage of the illiquidity premium. So that's one big trend that we're seeing in the adoption of alternatives. And the why. Why is there a demand? But then you go to the supply side, and the supply side is just as important. So on the supply side, all of these safe assets, safe private assets, the banks just used to be the beneficiaries of it. They all sat on bank balance sheets. But you're really starting with 2008, regulators across the globe required banks to hold more capital. And Basel IV will basically make bank products more homogenized than they've been in the past. And you look at the history of private credit. So lots of people talk about private credit. And what the headlines like to say about private credit is that it's the risky stuff. Well, you're right, that the first asset class that went off the bank balance sheets was the risky stuff coming out of 2008. The sponsor lending, the mid-market lending that's from 0 to 6 times EBITDA, that went from bank balance sheets to the investment marketplace first. That's what most of the world calls private credit today. It's a small, small fraction of what was on the bank balance sheets. It's a small, small fraction of credit that is not publicly traded. You know, what we're seeing come off the bank balance sheets now is large-scale investment grade corporate risk. What we're going to see next is diversified pools of risk, or ABS, investment grade through the residual tranches. So what you're seeing is you're seeing a lot of these assets that sat on a bank balance sheet where there was maturity transformation come out into the investment marketplace where the capital sources are much better suited to fund these asset classes. And so what that's going to mean is that there's going to be a lot more products for insurance companies, pension plans, sovereign wealth funds to invest in safe yielding but private assets. What this has done for the industry will actually be a sea change for the industry, because it used to be the case that if you wanted to really generate excess return on your asset portfolio, you invested in the old definition of alternatives, private equity, venture capital, hedge funds. And to earn excess return, you were taking real risk. Like that, there's real credit risk there. There's real risk of getting your money back. And that's in a levered balance sheet or a life insurance company. What all of these assets coming off the bank balance sheets allows you to do is it allows you to earn that excess return over a long period of time, but being safe. By earning more money for taking liquidity risk, structuring risk, complexity risk, but not taking credit risk. And what you've seen, at least what we've seen in our business, is the spreads that you can get on private investment grade assets have never been better. And we're actually now using that excess spread to de-risk other parts of our balance sheet. So this will be I think, a sea change for the industry. It'll be something that will fuel us for the next 10 to 15 years as the insurance capital and pension capital and sovereign wealth capital will look for these safe alternatives to generate that excess return over a long period of time.
Thanks so much, Matthew, for that sharing. We talked about a lot of risks. We also talked about different types of investments to try and mitigate some of those risks. But ultimately, when you talk about insurance sector, we need to look at stability. These are all long-term capital. So on that front, I want to turn to Romain. So what's the role of IAIS in bringing the stability to the insurance sector? And also, IAIS is developing a consolidated group-wide capital standard for large insurance companies. So what does that mean to to large insurers in general? And what are the expected benefits for that?
Yes, so thank you very much for inviting me to be on this panel today. Maybe it's a very broad question for me. We are doing a lot of things at the IAIS, so maybe I would like, first of all, to provide a bit of a background of what is the IAIS, and then I will maybe provide a bit of a highlight of what we have been doing to support the stability of the global insurance sector. So first of all, the International Association of Insurance Supervisors is an association of supervisors. We have more than 200 jurisdictions that are members of the IAIS. They are supervising collectively, I would say, over 97% of the world insurance market. And this association is the global standard setter. So our main mission is to develop and to maintain and to assist our members in the implementation of global standard for the insurance supervision. And the purpose of this global standard and the overall purpose of supervision is, of course, to ensure that we can develop and maintain fair, stable, and safe insurance market. So really the standard setting part is an implementation assessment, and supporting the implementation of our standards is a very important aspect of our role. And that's really the ecosystem of the insurance capital standard, to which I will come back later on. But we also have a mention to contribute to the global financial stability. That's an important role. I think what we have seen on the poll, all the risks that were mentioned, they are very much global in nature, right? And there's a lot of interconnectedness in the way we want to approach this risk. We need to have the global picture for them. So that really makes the role of the IAIS very important in terms of providing a place where supervisors can discuss and coordinate a supervisory response to this risk. And one important tool we have in terms of assessing and contributing to the mitigation of these risks is what we call the holistic framework. which we have adopted in 2019. And one important pillar of that is our global monitoring exercise, where we are collecting information from a pool of 60 largest insurers, but also from our members, looking at key risks and trends in the global insurance sector and the potential buildup of systemic risk. And I would like just to flag that we had 2 days of meeting of our monitoring macroprudential monitoring working group here in Hong Kong, hosted by the Insurance Authority. Thank you very much for that. We have a few members there, and they are working very hard to prepare for the next year global monitoring exercise. We've just released our global insurance market report this very week, highlighting what has been the key areas of work and discussion for supervisor, trying to contribute to this stability. And that's very much close to what we have heard, right? I mean, if I think of course, there's plenty of things in the GBAR, and I will encourage everyone to download it and to read it. But basically, I mean, our key areas of focus have been very much twofold. One, which is a little bit what you have been saying, a rapidly changing macroeconomic environment with this completely change in terms of the landscape with this higher interest rates, inflation, and also the pace of this change. And we have been looking at what would be the potential impact to the global insurance sector. I mean, a lot of industry players have been complaining in the past with the low for long or low forever, and how it could be creating a lot of challenges for long-term businesses, for the profitability and the solvency, particularly of life insurers. So in a sense, we appreciate that it's a kind of a good news if we are moving away from this low forever. But that transition and the pace of this transition is creating challenges. And they are creating challenges in terms of the liquidity risk, because that can create some unexpected needs for cash to address some margin calls or other types of situation or higher lapses, etc. And our supervisor have been very much looking at that, have been very much monitoring this risk, ensuring maybe a closer look at this risk, on the liquidity risk, but also a higher interest rate may also have some sort of an impact in the overall credit quality or potential credit deterioration, which can have an impact on the asset side. So we have been also very much looking at that. The second aspect, this will be more a little bit what you've said, is that it's not only the macroeconomic environment that is moving, it's also the insurance sector that is moving rapidly. And one part of our work has been to look at some structural shifts in the life industry. And among these structural shifts that we have seen is clearly higher appetite for private assets, alternative assets, depending on how you want to call them. So we've heard about the value of this shift, but of course, this is also coming with some potential risks. And I think part of our discussion was also to look whether we believe that the supervisory toolkit is adequate to this change in terms of, or shift in terms of the asset allocation. Another aspect that we have seen also is increased reliance on cross-border asset-intensive reinsurance. And that's also something that we have been very much looking in terms of what could be potential risk. And probably what is in common into these two shifts is that creates a bit of complexity in terms of the understanding, the opacity, potential opacity, and also the ability for assessing potential risk associated. Because of course, supervisors are not always looking at situations where everything goes well, but also in case something is going wrong. And lastly, one important aspect of our work has been to continue to look at the impact of climate change, which is certainly a major driver of all the risks that insurers are facing. Now coming back to the insurance capital standard. So the insurance capital standard has been developed within the context of COMFRAME, which is the common framework for the supervision of internationally active insurance groups. So for these groups that have a global activity, cross-border activity, coordination of work between involved supervisors is absolutely key. In 2019, we have adopted the qualitative pillar regarding governance, enterprise risk management, functioning of colleges, etc. But of course, we also need to have a quantitative pillar, and that's where the ICS come at play, which is basically to enable the College of Supervisors to have a common risk measure or common risk measure of the group solvency for these internationally active insurance groups. And how the ICS can contribute to the stability is because it's a risk-based standard. And the way we have developed that is really using all our members, designing the standard in a way that it provides a true measure of the risks, asset side, liability side, across various jurisdictions in a single type of measure. And it's really has to promote sound risk management from these internationally active insurance groups, and also to avoid any inappropriate procyclical behavior. So the ICS is almost finalized. We plan to adopt the ICS in December next year, and then it will become the final brick of this COMFRAME, and that will empower colleges of supervisors of these internationally active insurance groups to share not only a qualitative tool to their supervision, but also this very important quantitative tool.
Thank you. Yeah, it's very important because a lot of insurance companies operate globally. So these, kind of risk management framework is very important. So on that note, I want to turn to Jay, because AIA is really a multi-global insurer. So you operate across different countries in the region. So how do you manage those risks? And obviously, there are opportunities as well. Can you share some of those with us?
Thank you. And I want to thank the Insurance Authority for inviting AIA to be on the panel, and congratulations on another successful event. I think before I come to your question, I also want to make a comment on the theme of bamboo, because I think it's really a brilliant symbol of what we face across our markets every day, because the bamboo is fast growing, yet it's resilient, and it's strong, yet it's flexible. And those are some of the characteristics we need when we're working in growing markets. We need to grow fast, but it needs to be sustainable and resilient growth. And we need to have strong foundations, but we need flexibility as well in order to serve all the different marketplaces. So I really appreciate the symbol of bamboo for this conference. I think you also asked me about diversification of the business. And I think there's a few things that help a company like AIA in terms of the diversification of its business. And really the credit goes to many of the colleagues in the audience here today who've helped grow AIA into the phenomenal company it is. But there's probably three areas. The first one is the markets that we work in. The second one is the industry that we work in. And the third one is the approach. So if I look at the markets, we're in 18 markets across the Asia-Pacific region, and that gives us a tremendous opportunity to grow the company, but also that diversification benefits of how the different markets grow over the years. And the beauty is that growth of the markets isn't finished. If we look at the IMF World Economic Index, we can see that within our markets, they're predicted to take up almost 40% of the growth over the next, and GDP over the next 5 years. So the growth will continue in these markets. So it's the right place to be in terms of diversification. The second thing is the industry that we work in. We work in the life and health insurance industry. And we know that even though we've been growing these markets collectively over the years, the protection gaps have been growing faster than the insurance market is growing. So there's still tremendous opportunity for all of us to continue building these markets. And then the last one is the approach. I think here, of course, we have a risk management framework, and we manage all of our markets in a similar way, but we have to allow for that flexibility. Consumers are different in every single market that we operate in. They have different needs, and they have different ways of managing their risk. And so having that flexibility to tailor to each of the markets is another important part of risk management, but also diversification benefit.
Yeah, thank you. Yeah, we have a very comprehensive overview on markets in terms of opportunities as well as regulatory framework. Now, I want to take a deeper dive in our discussion. So coming back to Asia, especially Hong Kong, right? Let's look at the region first. You talk about investment, but a lot of these markets are quite illiquid and quite small. So from an investment perspective, and also from a regulatory framework angle. So I would like to start with Matthew, and then Romain. So please comment on those opportunities, those challenges. Who would like to go first? Yeah.
Well, so I think we've had a very interesting discussion in the last 2 days in our macroprudential monitoring working group, and I think we have been hearing all the potential the region has in terms of, well, at the end, serving policyholder needs, and then there's a huge need for developing insurance sector market here, and there's a huge need for cover. I mean, I'm not really the one that's best positioned in terms of discussing business opportunities in the region, but I would like to flag that, and I really want to echo what you say, growth is very important, but you have to ensure that you have growth in a very resilient way. You need to ensure that, I think one of the pillars of an insurance market is confidence also from policyholders about the resilience of the sector. And that's where the efficient supervision comes as an asset, I would say, for ensuring growth, and particularly when you have very rapid growth. And to that, I would like to note that at the IAIS, we see our members from the region very active in contributing to the development of our standard. I mean, particularly it's true on the ICS. We have done already a lot of work in adopting our standards, so really the remaining part is really on the ICS. So our members, and particularly the Insurance Authority, has been very active, contributing to our work, but also very active in implementing this global standard. And that's really, I think, is going to be an important asset for ensuring that while we are developing, the sector is developing, it can be done in a resilient way throughout a journey that might not be so easy because of the risk that we mentioned. I think another aspect, of course, I would like to mention is that there's an additional consideration that now we need to embed in our discussion is we mentioned climate risk. This is a very important one. This could have also kind of an impact in terms of the potential growth of insurance market. And what we are particularly looking at, of course, we have been looking at how to enable good supervision of climate risk and how we can ensure that we can use our global standard and the supervisory toolkit to supervise this moving landscape due to climate risk. But there's another consideration which is about a growing concern with regard to protection gaps. And a potential risk that due to reaction to the increase of NatCat disaster, there might be not the expected growth. So that's something that we have been tackling. We have just released an important report from the IAIS looking at how insurance supervisor can contribute to addressing protection gaps. Of course, it's not insurance supervisor alone that can provide a full answer to that. It has to be a joint effort from the industry, from policymakers and from insurance supervisor. But there's certainly an important role for insurance supervisor to enable that due to their knowledge of the insurance and their ability maybe to coordinate the different aspects of this response. And I think going forward, it's probably going to be an important area of work, a collective area of work. And I mentioned NatCat protection gaps, but there's maybe a broader question of protection gaps, and that's really fit into what we heard in the previous panel. And we had a discussion on cyber, there was a discussion on, we have this aging society. So I think this is going to be, even if it's not necessarily in the mandate of all our members as a supervisor, but we believe that is a very important consideration that will be probably at the heart of our next strategic plan.
Thanks.
Look, we're fortunate that we're able to see the insurance industry through two different lights across Asia, one with our asset management business and one with our retirement services insurance business. Look, it's interesting. There's lots of opportunities across Asia, but they're for very different reasons in a lot of respects. But the underlying driver from our lens is the need for insurance companies to be able to access safe yield, investment grade yield that consistently outperforms. And you think, okay, so let's go market by market. In North Asia, each market's going to be a little different because there are different demographics, different adoption of guarantees. So North Asia, there's been guarantees that have been written for a long time. And the reason they need safe yield is because they need to continue to make sure that they're profitable to pay policyholders and ultimately return something to shareholders. If you go all the way south to Australia, you have a defined contribution system that, in the super system, that is quickly going to become a retirement system. And you're going to have 5 trillion Aussie dollars of assets and savers' money looking for retirement outcomes. Now, it's a defined contribution system, but the purpose of the system is to optimize the amount of income in retirement, but make sure that there's a narrow band of outcomes within that optimization. That's going to be a mix of probably guaranteed product, as well as a different mix of assets. It's going to be really difficult to achieve those outcomes simply looking at the public markets, especially as the beta tailwinds unwind. And so there's going to have to be broader adoption of safe private assets. And then in Southeast Asia, a lot of it is about growth. And what's very interesting when you talk to the most sophisticated insurance companies in this market is, they've seen lessons of other markets, which is when you prioritize growth, you oftentimes forget about product level profitability. And on some level it's okay because it's the next person's problem. Not the regulators, but the next person's problem. And so you see this intense focus on ensuring that they're designing a very good product for the policyholder. But they also know that they need to make money on the policyholder, and they need to be able to make money on the asset side too, without taking undue risk. And so the marriage of that actually creates a much better ecosystem, a much better framework for guaranteeing outcomes for retirees or for savers. I think that you said something that rings well with us, which is making sure that the right regulatory tools exist in this evolving framework. Because the worst thing for our business, the worst thing for a lot of people's business in here is a surprise regulator. So the first thing that regulators need are the right tools to analyze the investment risks. Even if it's investment grade, need to really understand what the investment risks are. One of the benefits that we've seen in Hong Kong, and then Hong Kong specifically, and then also other markets in Asia, is the willingness to engage on what the investment risk is. And really think about what is the economic risk that the insurance company is taking and what's the appropriate amount of capital for that risk. And that's going to be really important because that's going to require from the insurance companies and the asset managers transparency, increased transparency, increased stress testing. But that doesn't do much good if you don't have on the other side a regulator, a regulatory partner that's willing to engage in the conversation and try and achieve what you need for the market. So lots of opportunities. Forums like these are great because you're able to talk about these issues and there's a real solutions mindset. But like I said, the worst thing for our business and other people's businesses is a surprise regulator. So ensuring that regulators have the tools and there's the right transparency to use those tools is what's really important.
Thanks. You talked about transparency, then we have to talk about data, especially ESG, right? So there are a lot of data transparency issue there. On that note, maybe James, you can comment from a rating agency perspective. So how do you deal with that? And also Jayne later, so as an operator, so how do you cope with that kind of risk? And also, what role Hong Kong can play in managing these kind of climate risk? Because we are the largest green bond market outside of mainland China in the region, accounting for 35% of the market. So there must be a role for us, right, to help manage this transition. So, James, please.
Yeah, sure. I can talk a little bit about the data side of things. Yeah. I think from a sovereign perspective, the times we used to worry about data availability has kind of passed. Most governments are pretty transparent about the kinds of data that we require in order to, rate the government. If they're unable to provide that data, typically we don't rate them. So, we rate 120 countries now. So I don't think we have to worry about the data that is required for us to do what we do on that side of things. On the climate side in ESG, I think, I could say from one perspective, there's nothing new there from our perspective in rating governments because the G part has always been critical. governance and how we think about how governments operate, how transparent they are from a policy perspective, not just a data perspective, but do they actually communicate what it is they're trying to do, not just to us, but to financial markets and to investors, and how good are they at that? How predictable is the policymaking framework? How effective are regulators and government policymakers? And that has actually historically had the largest weight within our sovereign rating model. So there's 18 different variables that we plug into an econometric model. Governance is number one, and that's not new. That's a kind of long-standing issue for us. So maybe I'll leave it there with a comment on the data side.
Yeah, thanks.
Yeah, I'll just add on to say that I think there are a few things that help us as companies to manage some of the risks that you talked about. The implementation of group-wide supervision and the things that come with it, I think really help all the insurance companies across Hong Kong to have a level playing field, but also to really understand and articulate their risks. Putting an ORSA together is an important exercise in terms of understanding the company's risks and the recovery plan that goes with it. So these tools that are introduced through GWS, I think, are really important in terms of understanding all those risks and managing them. And data is, of course, one of them, but there are many other risks that we can talk about. You asked about climate, and so maybe I just take a chance to say, you know, I think when I'm sure all the life and health companies in the room would agree that when they look at the risk of climate change, of course we have something to talk about on the asset side. But when we look at the liability side, the challenge we have is in having models that help us to understand the impact of climate change on things like disease burdens. And that's probably a task that's going to require many of us to work together to understand better. It's a long-term risk. Everyone faces it. It could be an opportunity as well. But what's most important is that we can understand it first. And I think that's an area where we could all make a leap forward.
Thank you. Yeah, I actually got a lot of questions from the floor. Maybe I'll start with this one first. So what is your advice to the Hong Kong insurers in riding through this financial market turbulence? Because we've talked about a lot of risks in our polling question. So I'll open this question to the panel. Anyone who would like to take this? Romain, yes?
Well, I would advise them to take the most of all our standards. I mean, sound risk management is absolutely key. Forward-looking perspective is absolutely key, and you mentioned how important, for instance, the ORSA exercise is a very valid one. You need to look at a perspective, different scenarios, and test how you are robust in different scenarios. You need to be alert to what could be a rapid move. That's what we have been having, very rapid changes in the environment. So that's probably needs to be continuously monitored. And sometimes I think the ability to rapidly tackle the situation is very fundamental. And I would say, I would definitely agree with you saying that engaging with your supervisor is absolutely key. Having a very good dialogue, open and transparent dialogue, is also very important to ensure there's a very good mutual understanding of, and of course, I know that sometimes in the discussion with your supervisor, you want to show that you are the most robust group in the world, etc. I think good dialogue is also sharing views on vulnerabilities. So I think that's certainly important.
From an investment perspective? Yeah, Matthew?
Look, we on this question, we think about we think about it in three dimensions. One is at the insurance company level, there's we call it the heart attack risk, which is liquidity. Your liabilities flee, and you don't have the liquidity to pay out those liabilities. I think one of the lenses that we've been using recently through our own book is, liquidity in the markets that we all thought were liquid 5, 10, 15 years ago are no longer the places where you're going to get liquidity when you absolutely need it. There's kind of no substitute for cash, and in some cases no substitute for treasuries or JGBs or whatever the case may be. And so I think really understanding the heart attack risk and where the sources of liquidity can come from, given that where liquidity exists in the market has substantially changed since 2008. The other one is the heart attack risk, or I'm sorry, the cancer risk, which we say is like, you've written guarantees that you're never going to be able to satisfy over a long period of time. And so it's just going to chew up capital over a long period of time. And that's really ensuring that there's a healthy focus on both growth and providing the product that's needed for any given market with the comments I made in the last round, which is really understanding the product economics. It's important that the product economics are profitable. That is not a shareholder point. The more profit that an insurance company can generate, the more cushion there is to pay policyholder obligations. It's first a policyholder protection equation. And then the third is really regulatory change. We and other insurance companies in this room are in the business of making long-term commitments. And I think in the last panel there was a point about regulatory consistency. I think ensuring that there's regulatory consistency so that the insurance industry can provide those longer dated guarantees is really important, and it's important to bring capital into these markets. So those are the three dimensions that we would probably highlight.
From an operator perspective, Jayne?
I mean, the only thing I would add to what they said, and it sounds simplistic, but I think, in the heat of the moment, you have to always ask yourself this question, is the topic I'm dealing with a long-term topic, or is it something that's just for today in the moment? And we're surrounded constantly with inputs these days. They're coming faster than we can digest them. And so being able to separate the ones where you need to take action versus the ones that are probably more noise in the system, I think is a critical skill. And it's probably one of the most important risk management skills that you can have.
Yeah, thank you. James, anything you want to share?
Yeah, just one thing. Look, there's the black swan, which comes along and you just can't foresee it, you can't prepare for it, you don't know what it's going to be, but it hits you in the face, that you have to deal with. But there's the other term, which I'm sure some people in the room know, the gray rhino. So the gray rhino, as opposed to the black swan, is a risk that you can identify, but you kind of ignore because you think it's too remote to deal with. And I think as risk managers, I used to be a risk manager at part of a risk management team at a financial institution, and I think, if you can identify a risk but you don't risk manage to it, you've only got yourself to blame as things materialize, right? So I think some U.S. banks learned a valuable lesson in that context earlier this year when interest rates moved against them. That's a risk that's identifiable but was not managed to.
Yeah, thanks. That brings me to another question that's quite relevant to the insurance sector. We talked about protection gap, Romain, right? So healthcare insurance in Asia is definitely growing. So what's your view on the opportunities and the challenges in developing health insurance in Asia and in Hong Kong? Maybe we start with you first, Jayne, as an operator, I guess.
I mean, it's quite a broad question. So I think, when we look at the importance of developing health insurance across the region, it's so different in every country because it very much depends on how much is in the private sector versus the public sector. So it's very difficult to say, one phrase about all the markets that we operate in particular. But clearly there's opportunity to develop this sector. We have an integrated health strategy to address specific areas around the health sector that we want to develop more. I think you heard Kevin say the same thing earlier on the panel. So I think this is clearly an area of opportunity for companies, but also for the general public, right? It's a need that people have. I think all of the health-related needs became even stronger coming out of COVID. People became more and more aware of their healthcare needs. So in terms of opportunity, I think we'll be talking about this for decades to come.
Any view from the regulator perspective?
Well, no, I will certainly agree with what has been said. I think maybe I will want to bring also into the discussion not only the prudential aspect, but also the market conduct aspect. I think particularly when it comes to healthcare, this is very important. We also are very active in looking in the diversity, equity, and inclusion as the IAIS. This is part of our strategic themes. And when we are looking at that, one of the aspects that we have been considering and the Market Conduct Working Group has been considering is how including D&I in the governance of insurers is also helpful in ensuring that when it comes to healthcare, you are also serving most vulnerable people, which is also very important in terms of the social value of healthcare coverage.
Thanks. Yeah, 5 minutes left. I've got one more question I want to bring up. That is the outlook for Hong Kong economic future and sovereign rating of Asian countries as well. So I want James to comment on from a rating perspective, and also Matthew, I want also to understand from an investment perspective how you see the risk on the horizon. Yes, please.
Okay, sure. Look, we rate Hong Kong AA minus. We rate China A plus. So I think there's two things, a couple of things that were already mentioned today. So I can kind of fold those into the importance of them from a rating perspective, from where we sit. One is the one country, two systems. So we have one country, two ratings, right? So we are subscribers to this view that the two systems matters, and the differentiation in terms of the economic policy making. And the other thing that was mentioned this morning already was the linked exchange rate. Quite important from a sovereign credit perspective. So we see an entity here in Hong Kong that has its own exchange rate, its own fiscal policy, its own tax policy, its own trade policy. It's part of a larger sovereign, but it has all of the characteristics of a sovereign, and that's why we rate it as one. And when I mentioned earlier, governance is a big part of our rating. That's also true in Hong Kong. And to be honest, we've downgraded the rating of Hong Kong in the last couple of years, in part because we felt that the governance of Hong Kong and the governance of the mainland was getting closer together, and we felt that the rating should be closer together. So we brought them to within one notch. You asked about the region. I think this is a region where the ratings are actually not that dynamic. So fairly stable outlook. I think the most positive story in Asia right now is in Vietnam from a rating perspective. We've had that on positive outlook for a while. We had that pre-COVID. We took it off. We put it back on. There's a fundamentally good long-term growth story, well supported by a number of factors in Vietnam. And I think right now, probably another positive story, which people are no doubt aware of, is the very solid growth story in India. That also, for demographic reasons, amongst others, looks like it has some longevity. So when we look forward, we see India definitely growing faster than China, and that can certainly help from a rating perspective.
Thanks.
Sure. We're not an active investor in government bonds other than what we need for purposes of our insurance balance sheets. But our lens on Asia investments. So look, our lens on Asia investments is the same for us globally. It has to satisfy 3 criteria. 1, purchase price matters. So for credit, that means being senior, top of the capital structure, and being very safe. In equity, that means buying good companies for reasonable prices. The second is we need to convince ourselves that we're actually generating excess return per unit of risk over what the banks can do and over what the public markets can do, because we've got different type of capital than both of those pools of money. And the third is if we're going to invest in something, we need to really love it. We need to want to invest in it with our own GP balance sheet before we're willing to offer it to clients at this point. And so, as we look at the Asia landscape, there's 2 big businesses that we have. It's a senior lending business to fill in the gaps that the banks have left. And increasingly, you see Asian companies demanding more sophisticated product, more sophisticated credit product, and also more diversified funding sources than the handful of banks that they may have regionally. And so we're a nice place to come to because, as we like to say, we're a great lender of second resort. If the banks can't provide it, the public markets can't provide it, we can provide it, and that's including to the investment grade companies. On the equity side, Asia's mostly been a growth market. So we like to, on the equity side, we tend to like to play that as partnership capital, where we're senior equity, and we can really be an equity partner to an entrepreneur or a family that's looking to grow their business or scale their business globally.
Thanks. Right. I would like to make use of my privilege as a moderator to answer that question as well, because I have to highlight that when President Xi visited Hong Kong July last year, making this important comment that the one country, two system is here to stay for the long term, and it's good for the nation. So ever since, we have witnessed a series of initiatives connecting Hong Kong with Greater Bay Area and the mainland China. So we're not just a super connector, we're also fast becoming China's international financial center and risk management hub. Just to name a few, we have the Swap Connect. We have what I call international Stock Connect. That's a basic extension of Stock Connect, including international companies nowadays to a primary listing in Hong Kong, tapping into China's huge saving pool, which is roughly 1.8 times of US GDP, that's something like $38 trillion US, right? And then we have, as an ex-fund manager, I'm very excited about this 18 measure, so what I call Private Equity Connect. And then we talked about Insurance Connect, the extension of that, and also improvement, enhancement on Wealth Management Connect. So GPA really solves two structural problems that we have in Hong Kong: limited land supply, limited talent pool. So on that note, I would like to thank our distinguished panel speakers for sharing their very insightful views on the heat map of global financial markets, highlighting the opportunities that we have in Hong Kong and Asia. Thank you.